All right. I think we're live. Let's just make sure everybody is in the. All right. We're going to give just a couple of more minutes for people to attend and join. I think we have the highest registers for this webinar. It's about 165 the last time I checked. Great job. So in one more minute, we'll start and introduce everybody. We have two Bill Pilkington. It's one, but one other one is a daughter, and we're super blessed to have two people participation there. Um, Let me see. Awesome. All right, so everybody's here. I'm not going to spend too much time on introducing myself. I'm going to actually spend time introducing the panelists here. Um, this webinar, by the way, my name is Sid Shamim, if you guys don't know me. But this webinar is particularly built to talk about real estate depreciation tax. And for obvious reason, I'm not the expert. Bill Pilkington is our CPA. He's very well known in Houston community and real estate community. He is the one who's going to help me get through it. It's a very, no offense, Bill, it's a very boring subject, but it's valuable for people who understand, right? So with Bill, we have Bill Associate, and my two associates, Camilla and Farah. So it's a big full panel host. So without further delay, let's start. Um, Bill, you wanna send your contact information and email in the chat box, and then that way I can just email and the phone number is fine.
Yeah.
Awesome. So if you guys want to get this slide and want to get in touch with us, this is a number 281-559-7061. I will throw that slide or that recording to our attendees afterwards. I have to show the disclaimer. Neither me or Bill giving any financial advice. If you want to know more, contact us or contact Bill directly. You have to be Bill's client or our investor to actually get get the right advice. Who's so this webinar or this education hour, we call it Legacy Wealth Builder. Who is this for? Right. This is for somebody who is a W-2 job owner or a business owner. This is for somebody who owns a personal residence or a stock investment or a real estate investment or even any kind of investment. Or broadly speaking, this was somebody who ever called an IRS code a tax loophole, right? Um, I was one of them when I started. Everything was me to me was a tax loophole, right? Because I didn't know how to use it, and I never called it IRS code. And I'm pretty sure, Bill, you probably have some clients like that as well. Um, I'm gonna go over some of the series of the questions and just point out a few things um, that I was going through, and that was my journey, right? And I'm just going to um, throw a series of questions in no particular order um, to present if this is something that you can connect with, right? So, when before starting into real estate and investing, I didn't know that if I'm making as a household family of 200,000 or more, I'm the ideal customer for Iris, right? They're the one who are catering for me. Iris is looking for me and applying tax on my income because I'm the W-2 um, household income that's making 200,000 or more, right? If that's you, you want to continue watching. Um, do you know that if you are making $200,000 as a family, And if you use a 4% rule, which means your return on investment is subject about 4% if you invest in bonds in traditional investing, you have to save $5 million to sustain your lifestyle, right? And that's a big amount of number. That's a big, big, big number. And majority of upper middle class or even upper class Americans don't have that kind of saving. How many of you think you are getting paid enough, right? If you think or getting a fair treatment by your employers, right? If that's something that you feel like, yeah, I could do better, this is the webinar for you. How many of you think that your line of profession um, comes under essential services, or it's a AI or recession proof? Not proof, resistant, right? Nothing is recession proof, um, but there are some professions which are AI proof, right? Um, there's a long way to go where AI can replace a plumber or a real estate operator or a CPA analyst. Those are things that are far in the process. But if you ask an average American, they will tell you that they are concerned as long as they're in marketing or sales or administrative work or anything that involves computer to finish your administrative work. AI is going to disrupt that industry. How many of you think that you are paying too much in income tax? Right. I was thinking when I started that journey that I was paying a lot, right? And I quickly realized that no, I was actually making less. That's why I'm paying a lot. And if you understand what I just said, you probably already investing, right? Did you know that an educated investor either pay no taxes or extremely low taxes, or in most cases die without paying taxes if it's planned accordingly. Yeah, right? And that's it. That is why we have Bill on this webinar today to help me give the right message to my audience and to help you if you want to get help with Bill. Did you know that an average upper middle class family can only survive up to 6 months without income, right? Which means the biggest risk that we as a working class Americans take is one source of income, right? And the moment we lose that one source of income, we on average have 6 months to survive the same lifestyle. And that number is even more stragglingly bad as you go towards a middle class family, right? Right now, I'm talking about upper middle class family or a little bit people who are making 200,000 or more as a household income, right? Husband and wife both working with two kids and things of nature. Did you know that an average healthy business should make 40% returns with some tax benefit, right? But in real estate, um, is the only domain or field that I know that you can make 400% or more, even with large tax shelters. And this is what we're going to talk about. If you know, if you are somebody who enjoys who enjoy uh, investments, who is doing good in their life and they want to give back, um, we have the same philosophy. We want to be more engaged in charity and give back. There are financing companies out there who will lend you money to give it to charity, right? And you can save that on your taxes. Um, Obviously, every situation, every person is different. Every tax situation is different. This is not an advice. It's just a tagline that I didn't know. Now I know, and I wanted to share that with my audience. Um, as absurd as it sounds, imagine if I go and Bill can correct me if I'm wrong. If I go to my parents and say, "Hey," or my friend, "Hey, I want to borrow money from you to give it to charity," right? They're like, "Why don't you give it to your own first, right?" So this is the case when you give away your own, and you can even get more to give more, and still save on tax, right? Something I didn't know. If any of this resonates with you, right, this is um, all it's saying is that if we don't know this, we are behind in the game of how things work when you do it correctly by using IRS codes, not IRS loopholes, right? So there's no such thing as tax loopholes. If you know the code correctly, and if you apply it correctly, you plan it correctly, um, you will see the magic of what financial independence can bring to. With all this being said, this is my team. These are the people who make me look awesome, including Camilla, Farah, Bill, um, Brian Farrow, Omar Nakwi, and my wife Anna Omar. We started this company with just one goal: is to invest into real estate. And it was started as a small single family house that we bought. And 12 years later, 13 years later, now we're running a full blown company where we buy apartment complexes, we buy uh, medical commercial real estate, um, and we help our investors to invest with us. Um, what differentiates us with most of the other sponsors out there or companies out there is that we are always the highest investor in our projects. Today, we are managing about 500, close to 540 million assets under management. We have about 3,300 apartment units and one medical building that we are a general partner. Our target has always been between 25 to 30% average annual return, and today we are managing about just about 400 and more active um, investors, or actively investing passive investors, if that makes sense. This slide is not to impress anybody who don't understand these numbers. You should not care about that. What you really care about is how we produce results. um, Second, let me, all right, so the previously I just talked about how many assets are we managing, what's the return we target. um, to me as an investor, I'm concerned about how do you perform on my project, right? How do you perform on asset that I'm invested, and that's how we do it. Um, I come up, we live by this flywheel every single day. Meaning me, my team, and anybody that work for us. This is the first thing that we talk about when we do our induction, right? When we onboard anybody in our company. And the reason I want to show this slide is because just one other day I was talking to my 8 year old, and I was telling him about the value, about how what is the meaning of having a family value, right? Why you want to be disciplined, why you want to be consistent. And his response was like, boring. Truly, the to me, I thought about it like this is the best compliment you can get, right? If you're a business owner or a professional, if you're consistent, right? If you're consistent on everything that you do, that's the best compliment you can get, right? Yeah, it'll be boring, but that's how you produce results. So um, we 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 pay deliberate attention to be always stay disciplined, consistent, to be purposeful, and to be focused. And our purpose is to give back, like most of you guys. Um, we as a family and as a company are working on several projects, and we're going to announce it pretty soon, and how we're going to impact our community, and what are the areas that we are really passionate about, so that you as our investor and audience can also look into that and shake hands with us. Without So today, right, if any of that still doesn't bore you, we're going to talk about how you shelter and save on your taxes by investing into real estate. Today's agenda is to go through why depreciation matters, what depreciation it is, how it will reduce your taxes, and what's the difference between a straight line and a bonus depreciation, and what happens when you sell. I mean, that's one of the things that, in my experience, 90% of the people do not think or plan is when what happens when you sell. I mean, believe it or not, I got a shocker last year as well when I started talking about selling some of these investments. And just recently, me and Bill sat down and kind of come up with a plan to what will happen if you don't plan it accordingly, right? And that's one thing that I was very passionate about. I wanted to talk about it with my audience. Um, and then we're gonna take a small case study and give you guys some ideas of how it's going to look um, from your angle as an investor, right? So the tax, so as a passive investor, right? Your depreciation, meaning your paper loss, right? So when you invest into a commercial real estate, by the way, this depreciation or the non-cash expense that comes out to you um, happens in particular scenarios, right? You may not get any depreciation when you invest in um, stock exchange or when you invest in any other business, right? Any other service business. Real estate, especially, is very famous and is designed by the IRS codes to get the tax depreciation. That tax depreciation can shelter most of your income, either from that same project or from your W2 income, depending on your situation. So, in other words, um, if you are a business owner and you have an income from your business, um, and if you are a W 2 employee and you come into a scenario where you or your spouse qualifies for those tax depreciation, you may able to get a big offset or shelter, right? I would like Bill, you to kind of comment on it. How how do you define as a investor's tax depreciation as a benefit to investor?
Yeah, so thanks. It's depreciation is how the IRS allows you to recover the cost of your purchase. And it doesn't matter if you pay cash for it or if you finance it with a mortgage. It's kind of like if you go to the store and you buy something with a credit card. The store doesn't care if you pay cash or credit card, you bought it. So that's just how you pay for it. How you take the deduction is based on what you purchase. So we're going to talk a little bit later on about like what qualifies, what doesn't qualify, and how you recover it. But this is if you think about it in real estate terms. Okay, I'm buying a building and land, basically. How do I get a deduction for that? And that's what allows you to come back through the depreciation. And it's I'd love to tell you just easy. It's one way, one size fits all. But maybe I don't know. Maybe that's why I have a job. There's different ways, and that's how it impacts each person. It's also very powerful because to know as you're going through, as you get 2, 3, 4, 5 different investments, then you're able to leverage a lot of the benefits of your existing ones to help you better decide how to invest in the future for your real estate.
Correct. So if I and again this is like Bill said, it's not one size fit all. Um, every situation is different, but in a broader term, what you can think of is that as a W-2 employee or as a business owner, if I'm investing in real estate, those tax depreciation can reduce my tax bills, right? And if that's in a nutshell, depending on your scenario, that's what it is about, right? Multifamily commercial real estate, particularly, is super. It fits really well in this superpower, quote unquote, right? Um, what depreciation means really is nothing but a paper loss, right? You bought a house. Uh, in the eyes of IRS, that house wears and tears and goes down in the value, right? In reality, it doesn't. It goes up, right? But when you look at from the deduction perspective, uh, the structure depreciates, but the land appreciates from IRS perspective, from code perspective. Um, and that is where everything comes down to, right? When you buy a commercial real estate, you try to take depreciation of the asset or the structure of the building and try to play it back into your balance sheet. So, for example, say your property. Now, again, this is the case. This is an example where we're not talking about your other income, right? We're just talking about the real estate itself. Say your property produced $10,000 of cash flow, and you took $8,000 of depreciation or paper losses. Well, now you're only paying tax on $2,000, right? In most cases, especially in apartment complexes, the depreciation is so high that your income almost always get offset 100%. Obviously, there's some rules applied. There are some passive activity rules. There's some income threshold. One of the things that I want to point out um, is the majority of um, people think that if you have enough big number of depreciation, you can offset all of your income, right? That's a that misconception is there only because a lot of people don't make that kind of income, right? So if you're making, let's say, 700,000 or more plus minus, your depreciation offsets until that point. But again, there are there are very few people who are making that kind of income, right? And if you plan it accordingly, you might be able to surpass that limit. So again, every situation is different. That's why we have Bill on the call on this webinar. And if you have a specific question, definitely connect with us or connect with Bill directly. We'll send his information at the end of the webinar. There are two kinds of depreciation, right? So one of the things that a lot of people um, that we do, right, is we try to accelerate and take a front load of deduction, right? So, Bill, do you want to go and quickly explain what are these two type of
Yeah.
depreciation look like and how does it help?
So again, it's kind of like where we said, like, there's not the one size fits all. So typically speaking, in the Internal Revenue Code, a single family property or residential property, which does include multifamily. I know I just said single family, multifamily. Residential is the term versus commercial.
Correct.
So, like what they do is they allow you to divide it out over 27.5 years. Again, it doesn't matter if you have a mortgage on it, you paid cash, you put half down, 20% down. Like, so simple version, it's 275,000 for the building. You're getting $10,000 a year every year, even. What that means is that that's how you're going to recover the cost. The way I kind of sometimes say it's like, if you put a log on the fire, imagine if that log took 27 and a half hours to burn. Same heat, exactly from the first hours to the last hour, nice and even.
Correct.
Now, sometimes there's other ways, and we'll kind of talk about it coming up. How can I get more of that depreciation early? We still get the same amount of depreciation, again, in that example of 275,000, but time value of money is often important. How do I get more of it early? And again, when we talk about the value, we're talking about really like the tax basis, meaning you purchased it and the IRS is going to let you take a deduction for it. It could be going up in value, meaning as far as the after repair value goes, but for tax purposes, this is how we're going to recover our cost.
Absolutely. Yep. So um, the part that differentiates between these two, what just Bill said, how do you take most of the depreciation upfront? And that's something called cost segregation, right? Bill, you probably remember that as well. I think the cost segregation study cost some money, right? And it used to be quite a bit back in 2010 and 11.
Yeah, and
Now it's gone down to as little as 2,500 bucks.
yeah,
That's what Ivy paid. Um,
different ones. Now, when you get your cost seg, you want to make sure use somebody that knows what they're doing, not just somebody who says, "Oh yeah, I can do that, and I
correct,
can cut
correct.
your hair, and I can fix your car." Some people will do it all over,
Yes.
but
So what it basically mean is you take your asset and you basically take the components out of it, and Bill will speak more to it. But in short, if you were supposed to take, let's say you have $100,000 of a real estate, and you were supposed to take $5,000 every year. I'm not doing the math, but let's say $5,000 every year as a depreciation for the next 27 years. Um, with cost segregation, it allows you. Obviously, you have to hire an engineer that knows IRS code and able to defend you when there is there's a requirement for to prove it. But these engineers in that cost segregation study can take majority of the depreciation on the first year, right? Why is it important? Well, if you take majority of depreciation first year, that that greatly helps with your tax shelter, right? And we as a sponsor, as a company, we always do cost segregation for our studies. Bill, do you want to define a little bit more about what happens in cost segregation study?
Yeah.
And as you speak, also talk about how do you identify a good cost segregation study company?
Yeah. So I'll start with the last one. A good company is one that will defend it to the IRS. We don't ever want the IRS to question it, but if we do, we want that company to stand behind it, meaning, okay, look, I only want to pay you and I only want to pay you once. So do you stand behind your numbers and will you defend them to the IRS if they ever ask? Again, hopefully the IRS never asks, but when they do, you want to make sure that that company has your back. But kind of taking a step back, what a cost segregation, like when I talk about putting the log on the fire, now imagine that same log on the fire and you cut half of it up. And then of that half, you cut it into smaller chunks. Maybe some are 6 inches wide, some are a foot wide, some are a foot and a half, but they're definitely smaller. Well, they're going to burn up faster over time. Some of those logs might burn up in the pieces that you splinter up in 5 hours. Some might burn in 7 hours. Some are in 15. But that last half, it's going to burn nice and even for 27 years. Half is hot, but it's still going to be even. At the end of the day, the same log burned up. It just, the smaller pieces burned faster. So you got more heat in the first 5 hours, and then those burn off. Then some of them burn off in 7 hours, then they go off. So you're front loading a lot of the heat. Now that's cost segregation. That's always been around. That's identifying different pieces. There's something they call bonus depreciation. That's where the tax codes go up and down. They've changed that over the last couple of years. Bonus depreciation means, oh, those little small pieces you cut up, we're going to throw a bunch of lighter fluid on them and burn them all in the first hour. So now we get a really hot fire in the first hour, and then an hour is 26. For the next 26 hours, it's an even hour. So we're really going to heavily front load it up front, take a lot of deductions, and that helps on the time value of money, getting deductions today instead of having to wait for the next 27
Correct.
years for them.
Correct. Correct. Absolutely. I mean, this example is for everybody, really. I mean, I always try to explain people with, a different example, but this final example, Bill, you nailed it. the, one of the things that I want to add here, um, remember how, like Bill said, you're taking smaller pieces and trying to burn it fast, and then take the bonus appreciation for the time value money. Imagine your $100,000 house, that example that we took. You're supposed to take $5,000 for 27 years. And remember that 27 and a half or 26 years, depending on if it's a residential or commercial. Sometimes a commercial can goes up to 39 years. But again, what it means is your your depreciation is going to live longer. Meaning, the $5,000 that you're saving today, do you think that $5,000 savings today will have the same value after 30 years? My opinion is no, right? And that's where the bonus appreciation comes in, where you take the whole 5,000 today and this year, right? So I'm just kind of dumb it down for people like me um, who are trying to understand exactly how and why should we do that, right?
Yeah. The other way I kind of describe it, you can look at two properties. One does a cost segregation, one doesn't. They can be side by side, kind of like the examples before and after. They can be the exact same property.
Yeah.
I call it like, think of like a hamburger. If you know what a Big Mac is, well, no cost segregation is just a Big Mac. Do a cost segregation on a Big Mac looks like two all beef patties, special sauce, pickles, lettuce, cheese on a sesame seed bun. It's defining everything that's inside of it. And because you define everything that's inside of it, much like that after, so like it says, how much is the home, how much the personal property, how much for the land, that's what allows you to take things faster. Some things over 5 years, some over 7, some over 15. That's the cost segregation. Bonus is the part that says, Anything that's below 20, write it all off the first year.
Yep, absolutely. So what happens later? I mean, that's one of the misconceptions that a lot of people think that once you take that tax saving, um, it's all done, right? That's not really the case. Um, there's something called depreciation recapture, meaning when you try to sell, right, there'll be the liability of that capital gain taxes. Um, the question is, how do we handle that? I mean, you know, somebody would ask, like, why would I not just go and pay the tax in the first time, right? Yes, you can definitely do that. But if you do the cost segregation, take the advantage of bonus depreciation, then you have to plan it accordingly so that when you sell your asset, the recapture of the depreciation don't come bite you back. I'll take Bill you on this slide. This is too technical for me to explain. Can you please simplify for us?
Yeah, sure. So here, simple version. Say we have that $100,000 property and we take the depreciation on it and we use 30,000 of depreciation. That's really good. We got a deduction today of 30,000. So to the IRS, that means your 100 is now worth 70. If you were to sell it the next year and only get your 100,000 back, so a normal person would think I broke even. That's not how the IRS works. The IRS says, no, 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 no. We gave you 30 last year. Now your asset's only worth 70. You have income. You have a gain of 30,000. And then depending on what that gain is for, because like we said, some of the parts we depreciate over 5, 7, or 15, but bonus, we took them in the first year. But some of the stuff that would take 27 and a half years, that's a different depreciation. Well, the IRS, again, they don't make it easy. They tax them differently. Some of it would be like ordinary income. Some of it might be as high as 25%. But the only way you get the long-term gain is to sell for more than your original 100. Well, okay, good. You got the time value of the money. But what if you've had it for 5, 6, 10 years and now your 100 is down to 20,000? You sell it back for 100, that's an 80,000 gain. That could be a lot of tax. Or maybe it went up in value. Now that 100 is worth 300. So not only do you recover your 80, you got to pay tax on another 200,000. There's an option that they call the 1031 exchange. It's another way of saying, like, I'm going to sell it, but I'm not going to really sell it. I'm just going to barter. I'm going to trade my property for another property.
Correct.
My property is worth 300,000. Doesn't matter what I paid for it. All matters is if I were to sell it, I could get 300,000. And I don't want to pay tax today. I found one more property, a different one that's worth 300. Or maybe I found two properties at 150 each, or three of them at 100,000 each. Either way, I'm going to take my asset that is worth 300,000 and I'm going to trade it to get another one that's worth 300,000. And when you do that, you don't pick up the tax. So the IRS is going to allow you to punt your taxes down the road. And so you don't pay tax today. You kind of keep like a little asterisk on the side mark going, hey, one day we'll owe this tax. Well, one day really means if you sell it outright. Big thing in real estate. Okay, we're all adults. 1 out of every 1 people die. So sorry, if you didn't know it, you're gonna die. You know, that's not our first plan. But the way it works, especially in Texas community property, as long as you don't have like a prenup or a postnup, and we're not talking about IRA money or anything like that, just regular money. You do your 1031. Well, we call it like defer, die. All that tax that you put a little asterisk, a side mark, okay, defer. If one spouse dies, well, the surviving spouse does not pick up a tax bill. They get to hit the reset button and start all over again.
Yep. Yeah. And this is, I mean, as terrible as it sounds, but mm, this is how wealthy people plan their things, right?
Yeah. And
Um,
it's and
and
that's with real estate. Like stocks, if your 100,000 stock grows to 300, when they inherit it, they'll get it for the 300. Yes, they do get the 300. They don't have to pay tax on the gain. That's correct. They do get to start all over, but they never got that first 80,000 of deduction. They never
correct.
got those depreciation deductions like you get in the real estate.
Correct. That's still leaving at least 20-25% more savings on the table, even if you compare apples to apples from stocks and real estate. And again, guys, if it's getting too complicated, I want to dumb it down. 1031 is one way to shelter the tax savings that you had in the first time, to move it, keep pushing, right? And
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 and you
yeah,
can do 1031 after 1031 after you can keep doing it. There's no limit.
yeah,
The only real qualification, and this is starting to get technical, it doesn't work on fix and flips. It has to be an investment property.
yep,
You might only hold it for a couple of weeks or a couple of years, but your intention when you buy it is, I'm going to hold this and collect rents on it for as long as I can.
correct. Great point, right? So that hold periods versus refinancing or selling. A lot of people, they hold the property long enough and just keep refinancing, right? And never sell, right? That's one of the best way that you can hold real estate for long term. And 1031, by the way, I just want to clarify, 1031 is a IRS code, not a loophole. So, and I joke this around because most of you guys don't come across investors who, if you're in this webinar, you already have been looking for real estate investment and you don't call these loopholes, right? IRS 1031, IRS allows to keep push your tax savings to the other properties. And that's what we want to do, right? We,
We're just
as a
following the
group,
rules.
exactly. Otherwise we wouldn't be doing a public webinar about that. And this is what we want to do. We want to keep buying and buy more properties, better quality properties, to move our gains and our tax shelter to other properties. Other thing that so that's one way of doing it, right? The other way of doing it, that you basically accumulate enough depreciation, right? So that if there's a few deals that you're trying to sell, or you're trying to um, real estate that you're trying to get rid of, that would still not impact as much because you still have too much depreciation carrying over from the previous years.
That's
You want to talk about that a little
oh
bit?
yeah, yeah. That's actually an awesome way, like I describe it, because there's active real estate investors, there's real estate professionals. Most people, myself included, are passively invested. I passively invest, which means I bank my losses. My losses on my real estate deals are held behind glass, and the glass says break in case of profits. So if I'm in 5 different deals and each one of them, say maybe I've got 20,000 of depreciation, so I'm sitting on 100,000 worth of losses, and I sell one of them and I make an 80,000 profit. Well, because I've accumulated 100,000 worth of losses, whether I buy another deal or not, I'm not going to pay any tax because I have to recover all of my losses before I start to pay any tax.
Correct.
So that's why I always say it's a good idea to have a plan B, C, and D. That's why it's a good idea to have more than one investment, because also you never know. One might sell the end of December, one might sell early January. You never know. But this way you're not having to scramble to find something fast. You're protected. That's why I say it's always a good idea to have several, because then it gives you more options as you start looking for new investments down the road. Because now you're like, I got enough loss to cover. And there's ways in your tax return we could show you how to calculate and see how much you have. But these are the things that, like, we work with a lot on clients just to kind of help educate them to know what they're doing so they can make informed decisions.
Awesome. Yeah. And again, these are just tip of the iceberg. I mean, there's so many other ways. There you can plan it through trust. You can plan this through other ways. I mean, ways that I'm learning every single day. So again, these are this the subject is boring, quote unquote. But if you, unless and until you really go into it and try uh, to educate yourself, it's never going to work. Multifamily, on the other hand, right, um, allows you to take most of the tax benefits early on. That's one of the reasons why multifamily, gas stations, even um, some of the mobile parks are very, very famous. And I'm just gonna, make sure that our audience understand that when we buy apartment complexes, we hire a professional, renowned cost segregation engineers and pay study that holds the IRS audit behind it. Bill, do you want to quickly touch how multifamily and maybe other different asset classes
Yeah. So
helps
what
with
what they
this
say is
bonus
again,
depreciation?
so like the ones that we're going to separate. So if you do nothing, the entire cost of the building takes 27 and a half years to depreciate. But through the cost segregation, we're able to then deduct it and take certain things over the faster time. So like air conditioning, so things that could come off like, so the ones that don't take, they will, even after the cost seg, will still take 27 years. Your structure, like your foundation, your studs, your roof, certain walls, the full amount of the bigger one.
Yeah,
Things we can start deducting faster: doors, security cameras, cabinets, carpet, interior HVAC units, sheetrock, lighting, and then even stuff like the asphalt out there in the parking lot. All these things that engineers go through, and they say, okay, you might have paid 2, 3, 4 million, whatever for it, but let me tell you what all you get for that. And they break it down line by line. And then what they'll also do, the good ones will say, in the event of an IRS, we'll say, yep, these are the numbers, these are the purchase price, we stand behind it, and they have all the documentation. So, like, I don't do that. I hire really good companies to take care of that for me. Never had one audited, but I don't want one to happen.
yeah,
And so it's way better to know, yes, I have a good one, someone who's standing behind it.
yep, absolutely. So, what does it all mean to you, right? Why should you, as a passive investor, should care? And this is just a four-liner of an explanation. Say you invested $100,000 in investment, in any investment, be it with us or with anybody else, and if it's a commercial real estate investment, your first year cash flow is 8,000 bucks, which is about 8%. If your sponsor or your company is doing the cost segregation and doing the bonus tax benefits, you're basically depreciating a $14,000 in your actual year end. Um, First year depreciation comes out to be negative 6,000 that carries over to the next year. So, in other words, um, this is a case when you're not qualified as you're just a passive investor, you're not active, you're not qualifying as a real estate professional. And if you do, right, you can take not only 100,000, but up to all the way maybe now I think it's bonus depreciation is back to 100%. It can go back to a full 100%, $100,000 negative that you can offset to your
Yeah.
income, right?
And what that means is, for tax purposes, it might show a loss, because understanding this same situation, if you have two buildings side by side, two different properties, two different people invested, one does cost seg, one doesn't, and they both cash flow $8,000, but one of them does the cost seg and they get 14,000 depreciation, and one doesn't, and say they only get 3,000. They'll still get some depreciation, maybe they only get 3,000. Well, the one on the 3,000, they're going to show a 5,000 income on their K1. The one that did the cost seg is going to show a negative 6,000.
Yeah.
They both cash flow the exact same amount. So it's not like, oh my God, what happened? We lost money. No, no, no. Just for tax purposes, we're not going to wait 27 years for our deductions. We're going to go and start taking some of them today. So because maybe we want to save them today, and maybe not. Maybe we at least let me bank them away
Yeah.
now, and then I will start drawing down on that in the future.
Correct. And that's why it's called paper loss, right? It's a K1 reported paper loss. It's not an actual loss. You still got the cash flow in the first year. And going back to our previous example, this is why you want those losses either to be used the same year or to be accumulated and carry forward to the next year. So that when something that you actually sell should save you from those accumulated losses.
Yeah, and you get to carry those losses as long as you own the property, or until somebody dies. So they don't expire on their own. Something,
Correct.
you either sell the property or you expire.
Yep. So here are some of the questions that we collected early on. while we were getting the registrations on. Um, and I don't want to go with all of those 10 questions. This can take another 20, 30 minutes, but I just want to read it out. And if these are the questions that you think is also connects with you, please reach out to us, right? Question number one: how do passive losses rules work if I have a W-2 income but no other passive income, right? Again, this is 99% of the case, right? uh, Definitely get in touch with Bill or with us, and we would love to help you and get you those answers. If a bonus question number two, if a bonus depreciation percentage changes, does deal still work well for after tax sales? Right. Um, yes. So the bonus depreciation, again, we probably have answered that for the last 1 hour. Your yield is different. Your returns, your actual cash return from an investment is entirely different from your depreciation. So it doesn't matter if it goes up and down. Yeah, it will. You will have less paper losses, but your returns are still in cash dollar value coming to your bank account won't change. Why multifamily is better asset type than others? Well, we just talked about it. You have so many other components that you can take the directions on. Um, how does a refinance affect depreciation in my tax before a sale? When you do a refinance, that money coming out is actually, and for lack of better term, is tax free. Right? It's not a proceed after a sale. Number five, can I use passive losses from one deal to offset passive loss to another? And says yes. But again, every situation is different. Get in touch with us or with Bill to get the right answer. How does depreciation recapture get taxed versus long-term capital gains? Um, I think we covered that. You want to go into detail? Send us an email. We would love to set up a time or even connect with Bill directly. 1031, we talked about it. Number eight, um, what is our process? I think we talked about it. We hire a professional company who stand behind the IRS, um, uh, follow the IRS rules, and stand behind if there's an audit. We never had an audit, but if it ever happens, they are the one responsible to defend us. Why? Because we paid them as a professional company. Um, Number nine, how does Headway plan hold or exit to optimize tax outcomes? Yes, that's one of the things um, we are moving towards, where we basically move from one property to another and do a 1031 exchange as much as we can, as many people as they want to stay in one from one day to another. What support does Headway provides around K1 timing and coordinating with my CPA? That's a big deal. And we are extremely thankful to Bill and his team to give us a priority on providing the K1. Our K1 timings are anywhere between February to March, right? So or early March. We have never ever been late on our K1s. Our official deadline, quote unquote, is March 15. But Bill, you didn't hear that. Your deadline is still February 28th, and our deadline is to provide you by January, right? To all the data. Um, how does it work with us? How can you invest? If we invest in apartment complexes, as we've talked about, we have an income fund that is not depreciated investment. It's a regular 8% return investment. But so we invest in three different ways, right? We have an apartment complex investment, then we have um, income fund that pays out, that gives loan to other real estate investor, and we stand as a first lien um, uh, uh, holder on those real estate. And the third thing that we just recently started, we did our pilot project already, is the medical cash flow medical real estate. We're actively looking into buying, um, you know, uh, small medical hospitals or ER centers or surgical centers, and this is something that is still in works. But these are three ways that we actually work and invest in real estate. These are our three um, product lines, if you want to say. If you want to join us, definitely take this QR code and join our community. We do these webinars once a month. We have done so many other webinars over the years, and they're all on our website. If you want to know a little bit more about your about income fund as an offering. This is a QR code. You can uh, use that, or you can simply call to this number, 281-559-7061. Um, with that, Bill, any closing remarks? I know we covered a lot in, yeah, this is one of my favorite topics toward the end of the year. It always gives me adrenaline rush for next year and things that we want to do. Any closing remarks from Bill, please?
Yeah, no, thanks. I appreciate the time. I know today was a little bit like drinking water from a fire hose. So, I do understand there's a lot of things, a lot of different topics. So it's just, we're trying to help out, give you a little understanding. Today was not designed to make anybody the experts, and it's, I know like we talk about like the IRS, the loopholes, and like, I've often heard it's like, no, like a loophole is something that benefits the other guy. But if it benefits you, that's called tax reform.
Correct.
So, when we take care of it, we're here to help support you. I really like working with Sid and his team. Umar, they help get us a lot of the information. So we're working together, and because they always want to make sure that everybody has their information out on time too. It's like, I remember, I had a really good person one time. He told me, okay, good CPA, get my K1s out on time, get my K1s out on time. Oh, did I mention get my K1s out on time? And so we're working there. Just always, when you have questions, it doesn't have to be me. It could be your own. If you got your own CPA, just make sure you're keeping in touch with them, what's going on, keeping up with the latest rules. And everything's different. So what applies to one person may or may not apply to another. Everybody's situation is unique. But overall, it's like, again, like, some of the reason I like a lot of this stuff because I invest in real estate myself.
Yeah. Yep. Look again, guys. If you want this slide, text us on this number. Um, if it makes it any better for you guys to feel, even I don't understand the whole thing that we just talked about. There are some areas that I'm still very green or gray. Um, and if you're just like me, I mean, trust me, you're in the right track. It's never going to be one webinar or one presentation or one small meeting that can help your tax planning or situation. So for that reason, definitely get in touch. I will once we send you guys the recording, I will add Bill's information in there. Um, with that being said, thanks a lot for your time. We're just closing to our hour mark, and hopefully we'll see you next month. Thank you.
Thank you very much.